Okay, hi there and welcome to another video looking at the economics of the coronavirus global crisis. In this video, we're going to be thinking about some of the macro policies that are being introduced in the UK specifically to prevent an economic depression. Headlines from the papers today, the Times flagging up the wages bailout for workers, which may have saved upwards of 1 million jobs. Of course, that's a very uncertain estimate to make. The Guardian saying that Britain is shutting down. The Edinburgh News reminding us that scarce products arrival. One person's consumption affects consumption of things available for other people. And the FT, Sunak turns financial firepower on efforts to ward off the imminent jobs crisis. I hope you're following the news dramatically as it is, hard enough as it is. The coverage is often quite superb in the quality press. Rishi Sunak, 20th of March 2020, the economic intervention that I'm announcing today is unprecedented in the history of the British state. The first point I want to make is that the coronavirus is clearly a public health crisis, first and foremost. But it's also creating a severe economic crisis, probably of an order of magnitude bigger than the global financial crisis of a decade or so ago. And of course, the two are inextricably linked because with the public health crisis, we're being told and asked to self-distance, to physically distance ourselves, to shut down our movement on the grounds of flattening the curve. That, of course, has severe immediate economic effects across different industries. The International Labour Office is forecasting that global unemployment may rise by 25 million or more. Again, people making these kind of forecasts, it's their job. It's essentially putting a finger in the air and coming up with a number. Who knows what's likely to happen in the weeks and months to come. The crucial point is that the coronavirus pandemic, is both a supply side and a demand side shock to the economy. On the supply side, production is closing down, factories closing down, supply chains affected, layoffs increasing. The aggregate supply curve in the short term is shifting to the left. This is not simply a movement down the aggregate supply curve. The danger, of course, is that a temporary shock to production could have long-term hysteresis effects, damaging effects on productive potential. And of course, we know that coronavirus is both a demand side shock as well. Private sector demand is falling. C plus I plus X. Fall in spending, partly physical. People don't have the incomes. And secondly, of course, it's psychological. A steep fall in animal spirits, consumer and business sentiment. And we know that a negative demand shock can then lead to Keynesian negative multiplier effects, which amplifies the effect of the initial shock. Richard Baldwin, in his latest Vox EU paper on the impact of the virus, I'll provide a link at the end of this presentation, has reproduced a circular flow diagram. And the X's mark the displacement points, the shock effects, the close down points, if you like. The coronavirus is a disruption to many parts of the circular flow model. Indeed, some have likened it to an economic cardiac arrest. And there are many risks of this. One is that a sudden and large drop in output in the circular flow and employment therefore leads to stops in incomes and ultimately can, of course, cause the long-term supply side productive potential of the economy to be damaged. Here's a really good chart showing the international supply chain linkages in the ICT sectors, from iPhones to smartwatches and many other products. Global supply chains have become synonymous with the deepening of globalization. The component parts for what is now a standardized product, such as an iPhone, comes from many, many different countries. This chart is revealing. It shows that China is the workshop of the world when it comes to ICT products. Still, although there are some significant supply chain manufacturing capacity in countries like Korea, Japan, Vietnam, increasingly Taiwan. It also shows that Germany is the European supply chain network hub. Massively important what happens to the German economy in the months ahead. By the way, in this chart, the size of the bubble, each colour reflects the size of the country in terms of the value of trade. And the connecting lines show the relative importance of trade flows across countries. So it looks like Southeast Asia will probably have the biggest supply chain effect when it comes to ICT goods. Well, I think crucially, if you're following the crisis, as I'm sure you are, I think the crucial question, which is yet to be determined, is how resilient economic systems are, financial systems, social systems are, how resilient they are faced with this period of radical uncertainty and stress. Sadly, the coronavirus pandemic has struck at a vulnerable time in the world economy. China was already slowing down, the German economy on the brink of recession, UK economy's growth less than 2%. So the timing of this negative shock has been particularly unfortunate. And the biggest nations hit hardest by COVID-19 are almost identical to the list of the 10 biggest economies in the world, Iran and India being the exceptions. If you take G7, United States, China, Japan, Germany, Britain, France and Italy, they account for nearly 2/3 of world supply, world demand, 2/3 of world manufacturing and 2/5 of world manufacturing exports. Now, when there is a collapse in private sector demand and private sector employment, we look to policy, specifically monetary and fiscal policy, to act as a vital counterbalance, if you like a stabilizing function that policy can make. This chart's revealing, if you get the bigger picture for what the UK government can do, this chart shows the main sources of tax revenue for the UK in the current financial year. And the big five: council tax, corporation tax, VAT, national insurance is second, and of course income tax, nearly £200 billion of revenue. This puts the size of the sugar tax and the soft drinks tax in proportion at the top there. So what is the government doing? Well, just in the last week, if we think about both the government and the Bank of England, base interest rates have been cut from 0.75% to 0.1%. That's less important, I think, than the expansion of quantitative easing, expanded by £200 billion to include purchases both of government debt and also corporate debt. And then we had a round of fiscal policy stimulus early on in the week. This £300 billion interest-free loan scheme where the government would guarantee loan finance for businesses, now upgraded to 12 months. Relatively small cash grants for businesses in hospitality and leisure, of course, which is closing down. A mortgage holiday for 3 months. And the abolition of business rates for this year for businesses in those sectors. Well, that was round one, and it was clearly never, ever going to be enough to prevent a dramatic loss of jobs. So yesterday, Sunak in the press conference announced fiscal policy round 2, in particular coronavirus job retention scheme. The government is committed for 3 months, in reality it will be 6 months or possibly more, to cover 80% of the salary of retained (furloughed) workers, up to a total of £2,500 a month, equivalent to £30,000 a year. So furloughed workers remain on the payroll, they remain employed by a business, but they may well be given, let's say, temporary leave for the duration of the crisis until movement restrictions are relaxed. So firms are not making workers redundant, which would add directly to unemployment. They're retaining them on the payroll, they're being furloughed, but the government will then cover directly through a grant 80% of the salary. So if you have somebody employed on £30,000 a year, let's say, over the course of a year, the government would pay £24,000 of that and the employer would pay £6,000. This is an incredible intervention, really, quite generous in many ways, although there are holes in it where the government effectively is nationalising part of the private sector and paying people's wages. They've also deferred VAT payments to the end of June, and they've also uprated universal credit allowance for the next 12 months by £1,000 a year, £20 a week for the average claimant, perhaps a significant increase in their disposable income, although perhaps the government will have to do more. Well, in total, these fiscal support packages over 3 months are probably worth about £50 billion, bigger than fiscal stimulus in 2008-2009, but the reality is that it's not likely to be 3 months, it's likely to be 6 months or more, and the government may well have to come back with fiscal policy round 3 to do whatever it takes to prevent mass unemployment and a depression. Some brief evaluation thoughts and maybe one or two questions. Nominal interest rates have fallen. Okay, they've fallen in the UK from 0.75% to 0.1%, and that's true in most developed countries. 30 odd central banks cut interest rates last week, but actually those interest rates didn't have much to fall, and some countries are reluctant to move to negative interest rates. This is in part a legacy of the financial crisis 12 years ago. Interest rates were cut very quickly. They haven't returned, if you like, to normal levels, and that's given central banks less room for manoeuvre in cutting interest rates. And do low interest rates have much of an effect on demand anyway? Keynesian economists would argue that advanced economies are likely to be in a liquidity trap where even zero interest rates have little effect on consumer confidence, investment spending by firms, because the uncertainty, the wait and see approach dominates. The psychology of the situation can render monetary policy ineffective. I would argue, many others argue the same, that keeping people in work and preventing profitable, successful, viable businesses from going under is the most essential part of government policy at the moment. Most businesses fail not because they aren't profitable, they fail because they run out of cash. In other words, their revenues collapse and the cash flow of the business becomes strongly negative, and ultimately they run out of cash, and if they can't access loan finance, that's the end of the business. Now, if fiscal policy doesn't do enough to prevent depression, then there could be a period of deflation. And if prices start falling, well, the real interest rate on debt goes up, not down. Because, of course, the real interest rate is the nominal interest rate minus inflation. And if you have deflation, it's minus a minus, which becomes a plus. And that, of course, in theory, can make the depression much worse. Economic students and teachers tend to treat monetary and fiscal policy as two separate topics on the exam specification. For the moment, fiscal and monetary policy are effectively becoming unified. Central banks will be the main means by which this unprecedented fiscal stimulus will be financed. Some people have likened the economic situation to the economy suffering a cardiac arrest. You need something to try and breathe life into the economy. Others are saying that this shock has created a huge sinkhole into which jobs and incomes will fall. Well, you need something to fill that hole, and it's fiscal policy financed by monetary policy which will be the way ahead. A final thought, a final question. If the government will probably have to go much further. I stand to be corrected in the months ahead, but perhaps the government may move eventually, if the crisis deepens, not just to supporting businesses directly through a wage subsidy, but also supporting people who are not on benefits with a universal basic income, perhaps financed by an expansion of quantitative easing. Are we getting closer to universal basic income becoming a policy by default? A couple of things to recommend, and I'll put some links into the comments section of the video. The BBC Real Story podcast is absolutely tremendous, and I've drawn on some of those arguments in my presentation here. They had a special on the economic crisis of the coronavirus pandemic. 50 minutes, well worth listening to. And likewise, Richard Baldwin and his colleagues at Vox EU have produced 2 free ebooks which are covering the economics of the crisis, and these are being written by professional academic economists. Really, really well written, clear information, and these ebooks are being disseminated and published as we go through the crisis at the moment. And of course, we're only at the foothills of what is likely to happen. So there we go. Hopefully you found this short presentation useful. This was actually a presentation I gave to my own students today, trying to get them to think about some of the macro policies that could be helpful in helping to ward off depressionary risks. Follow the links on the website. I'll put some extra links if you want to take this further. But for now, thank you for joining us.